Welcome to Cat Eye U.S. stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's reset. Quick look back at the week, then set up the next open. Early on, it was all AI optimism. By the finish, it flipped to geopolitical anxiety. The headline? Oil, crude ripping through $100, woke the inflation monster back up. That's basically a tax on the consumer. Then Friday's jobs shock hit, and suddenly the market was staring at a worse mix. Slower growth, hotter energy. That's why stocks bled into Friday's close, and why Monday's open is all about gap risk and headline risk. On the weekly view, this wasn't some gentle dip. It was a hard down week that got worse right into Friday's close. The S&P 500 finished around 6,740, down about 2% on the week. The Dow dropped closer to 3%. That tells you de-risking hit more than just one pocket. The Nasdaq held up better, off about 1.2% thanks to selective AI strength, but it still faded late week. The real warning light was the Russell 2000, down just over 4%. That's your classic financial conditions are tightening tell. Small caps take the first and hardest shot. Off that weekly damage, the money flow was pretty straightforward. Capital moved toward cash flow and inflation hedges. Energy led because higher crude is an immediate earnings tailwind for producers, and it forces the market to reprice inflation risk. On the other side, small caps and high beta lagged the most, exactly what you'd expect when conditions tighten and traders dump index and ETF beta first. The only real silver lining? Selective AI and semis. Investors still paid up for visible, durable growth, but even that was fighting the tape into Friday. Over the weekend, the bridge to Monday is simple. Headlines: this is a live developing story. Multiple reports are flagging crude above 100 and even higher if Middle East tension escalates. If oil stays bid into the next open, inflation anxiety stays front and center, and the Fed narrative gets tougher. Also remember, crypto trades 24/7. So if you see a sharp Sunday night move, it can front-run risk appetite or risk aversion before equities even reopen. None of that is a trade by itself, but it absolutely shapes Monday's gap risk playbook. First stock on the tape is Exxon Mobil, ticker EXOM, and this is a past week tell. As the market started pricing an energy shock, energy equities turned into one of the cleanest relative safe harbors. Exxon matters because higher crude quickly feeds into stronger cash flow expectations for producers. Heading into the next open, the setup is simple. If oil stays elevated on headlines, energy can keep leading. If crude fades, Exxon can give back in a hurry, and that would strip away one of the only clean tailwinds this tape had. Next up is Broadcom, ticker AVGO, and this was a standout resilience story. Even as macro fear took over, Broadcom held up on the idea that the AI buildout is still real and still funded because it's tied to durable infrastructure spend. That signal matters. In risk-off weeks, the market often narrows to cash flow quality winners. Heading into the next open, watch whether AVGO keeps acting like defensive AID. If it holds while the index chops, that's constructive leadership. If it breaks, that says de-risking is spreading into the AI complex too. Nvidia is still the market's permission slip for risk, especially after a week like this. AI pockets held some demand, but macro de-risking took over into Friday. That's why Nvidia matters so much. If it stabilizes, the Nasdaq has a shot at leading any reflex rally. If it loses support and rolls over while oil is still bid, that's your confirmation this is broader degrossing, not just a one-day scare. Now a next week watch, OKLO, ticker OKLO. This isn't about debating the long-term story, it's about event risk. The company is set to report full-year 2025 results and a business update on Tuesday, March 17th, after the close. In a week where oil is spiking and the Fed is in focus, speculative growth names with catalysts can swing hard, heading into the next open and into next week. This is the kind of ticker where sizing and timing matter more than conviction. Fifth stock is Costco, ticker COST, and this was a past week message tied to the human override. Digital scale and durable models still win, even in a macro scare. In a true bad news is bad news environment, investors often crowd into perceived stability and cash flow resilience. But here's the tension. If oil stays high, that's a direct tax on the consumer, and that can change how the market prices demand. Heading into the next open, watch whether Costco acts like a defensive hideout or starts to crack, which would signal stress is spreading beyond just high beta. Heading into the next open and the coming week, think of this as a risk management calendar. Monday brings the Empire State Manufacturing read, Wednesday is the make-or-break sequence. CPI as the inflation gut check, then the Fed decision, the statement and projections, and Powell's press conference. Thursday stacks unemployment claims, Philly Fed, and new home sales. And over all of it, you've got the continuous catalyst, geopolitics and oil supply headlines. In this regime, one weekend headline can matter as much as a data print. So plan your levels and your position sizes accordingly. Wrapping it up, the close really told the story. Small caps broke down the most, the Dow underperformed, and the whole market repriced around higher energy and weaker growth signals. Over the weekend, oil stays the headline risk, and that's what can set the tone for Monday's open. The only consistent bright spot is still selective AI infrastructure and mega-cap quality. But even that has to prove it can lead in a macro shock. Get some rest, map your levels, and head into the next open ready for gaps and fast reversals. Thank you for watching Cat Eye U.S. Stock. Stay curious, stay calm, and we'll see you next time.